Everyone talks about once-in-a-lifetime buying opportunities after they've already passed. But what if you could actually recognize the moment before it happens, before the bottom hits? In this video, I'm going to show you how to spot true value before the crowd catches on and why most investors miss their shot every single time, hoping that it causes you to think just a little bit right here. The best time to buy stocks isn't when everyone feels great. It's when everyone is freaking out. But remember, the idea of implementing it is a lot harder than the idea of saying it. Now, I know it all sounds weird, but it's absolutely true. When the news is full of panic, the stock market is dropping, your friends are saying, I'm just going to wait until things settle down. That's when the true smart money, the true smart investors will get interested. Does that mean they're picking the bottom? Absolutely not. That is still a virtual impossibility. So let's break this down like a story. Because once you understand the story of how real investors think, you'll hopefully never look at the market the same way ever again. Imagine walking into your favorite store, the stuff you love. I don't know what it is, games, shoes, snacks, purses, whatever it watches, all 20% off. Would you walk out? Absolutely not. You'd stock up, right? It's harder when the market's going up and a stock you love or own is going down. But here's the thing, guys. The key to all of this is you only buy when you have a clear understanding of what the stuff is really worth. When you have that margin of safety. When good companies go down in price, not because the business is broken, but because people are scared, you might be looking at a great buying opportunity. A lot of people will call this catching a falling knife. That sounds real dangerous. And it can be if you're actually catching a falling knife. But most of the people who say that are too caught up in the story and they're not paying attention to the fundamentals. The example I always give about Microsoft in 2011 when I thought it was great, and I had a tech CEO tell me that Microsoft was dead. And I'm like, if it's dead, how is revenue going up 7-8% a year and profit is going up 11% a year consistently? They only had 1 year in which revenue went down. That was during the great financial crisis. He was paying attention to the story of Microsoft price, not the fundamentals. It's only risky if you don't know what you're grabbing. And guess what? The third principle, the third tenet of our principle-driven investing is if you don't understand it, don't buy it. I'm not telling you to buy things just because the price is going down. If the price is going down and you understand it and the price is well below value, that's when you go grab it. Let everybody else think it's a falling knife. That's the point for you. If you know what something is worth and it drops in price, it's not scary, it's smart. In the great financial crisis, the same houses that were selling for $120,000 to $150,000, I was buying for $10,000, $12,000. Did I feel like I was catching a falling knife? Absolutely not. But you know what people were telling me? You're buying toxic assets. That was literally the term given for real estate. Now, Warren Buffett is one of the best investors of all time, and he's got some advice that can help anyone, even beginners. And guys, that's the key to these videos. We start as simple as possible and keep getting a little bit more in tune. That way these videos make sense to everyone, whether you're new or whether you're advanced in investing. But here are the three things that Buffett says, and I've already talked about one of them. Be fearful when others are greedy, and greedy when others are fearful. What does that mean? When everyone is buying and the market is booming, be patient, slow down. I'm not saying stop dollar cost averaging, but when it comes to individual stocks, don't chase those companies that everybody's buying indiscriminately. And when people are scared and prices are falling, that's when to start looking for deals. Now, why is that difficult? Well, in the great financial crisis, stocks were falling and fundamentals were getting a little bit worse. Actually, in a lot of cases, a lot worse. But the question is, did you believe that those worst numbers were going to go to zero? If you believe that, you're not meant for investing, and that's okay. Just dollar cost average into low cost ETFs, and you'll make a ton of money in your life. But if you want to buy individual stocks, you've got to realize when those black swan events happen, every company is basically going to get hit on financials. Like I said, Microsoft even did. I think it's the only time in their public history, actually since day one, that their revenue fell year over year. You've got to start looking for deals when that happens. Second thing Buffett says, whether it's stocks or socks, I like buying quality merchandise when it's marked down. So think about that. Would you avoid that favorite item we were just talking about before because it's on sale? Of course not. If it's good quality and the discount is great, you need to go buy it. Same goes for stocks, especially for stocks, because you can have too many hoodies. You can be like, you know what, this is a great deal, but I already have enough hoodies. I don't need more. With stocks, you can never have enough good stocks at great prices. Third question, and what I think is one of the most important ones. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Buffett isn't trying to make a quick buck. With that said, you see a lot of transactions in his investment portfolio going in and out. He likes to buy companies he believes in and to hold on. He's patient. Guys, if you were to buy a part of your neighbor's mechanic shop, can you buy it today and then sell it 2 weeks from now? No, you're in it for the long haul. If there's bumps along the road, revenue goes down, profit goes down, would you sit there and worry every single day about what the value is? No, of course not. In the stock market, though, it's hard. Why? Because we have this ticker going up and down. Guys, I'm not kidding when I do this. When I log into my broker, and you got to remember, the market is up like 30% since April 8th of 2025. We're at July 11th, July 10th right now. That's a big increase, the fastest ever, I believe. And guess what? When I log into my account, I hide my balance because I don't want to get caught up in the euphoria of seeing that balance go up. It gets my emotions going of like, oh, yes, I'm right. Just like when it's going down, I don't want to sit there and see a stock going down and thinking, oh, I'm wrong. I keep myself away from that. Why? Because I want to sit there and make rational decisions that matter in the long run. Every day, somebody will mention a stock that I own and go, oh, did you see it's up this much? I'm like, yeah, I have no idea. That's the only time I hear about it. And guys, you don't need to be a financial genius to follow Buffett's plan. You need to stay calm. You need to think long term. Now, Peter Lynch, who's another top investor, likes to keep things simple. In his book, he shares a funny idea called the cocktail party theory, which we've talked about many times in this channel. And it goes like this. Stage one, the market's down. Nobody wants to talk about stocks. If Lynch goes to a cocktail party and he says he works in the stock market, people will walk away or talk to the dentist about plaque or feel bad for him. That's when the market's usually a good time to buy at or near a bottom. Stage two, the market's up a little bit. People say stocks are still risky and they move on, but they still talk about it. Maybe stocks are fairly priced. Stage three, the market is up a lot. It's gaining momentum. Now people at the cocktail party are asking for stocks. Hey, Peter, what you got? What you got? So things are getting a little bit more heated, but things are probably still okay. Stage four, everyone is obsessed. Euphoria is stepping in. The dentist is giving advice. The cocktail waitress is giving advice. That's the sign that the market is probably too hot. When it's too easy to make money and everybody's making money, that's usually a problem. Which stage do you think we're at right now based on where the market is? Peter Lynch doesn't believe in guessing where the market's going. He believes in understanding what you own, buying strong companies, and holding them for the long term. Now, here's the truth. The media won't warn you before a crash. The news will not follow fundamentals. News follows the stock price. Guys, 3 months ago, a lot of banks, including JP Morgan, were lowering their estimates in the S&P. I just saw a report this morning that JP Morgan is talking about higher and higher highs. Guys, 3 months ago, it was a totally different story. The media will shout when things are bad. They'll cheer when things are good, but they won't tell you when to buy. That is your job. Real investors don't make decisions based on headlines. They look at the fundamentals. How much does a company earn? How strong is the balance sheet? Is it selling for a price where price is lower than value? Bad news is a good thing for smart investors. When everyone is scared, prices will drop, even for great businesses. That's when opportunities show up. Guys, I would actually argue that prices probably fall harder for great businesses because when there's indiscriminate selling, especially in the S&P, all the big companies in the S&P, which tend to be the best companies, will fall very hard. Guys, a few years ago, Meta was in a free fall. It had fallen all the way to $88 a share on November 4th of 2022. Why do I know that date? Well, that was the last day I made a purchase of. I happened to get it at the exact bottom. Now it's at $600 and some a share. Back in November of 22, Zuckerberg's an idiot. We need to find a new CEO, blah, 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 blah. Same thing with Google. When it was at $85 a share, the CEO's an idiot. We need to find a new CEO, blah, 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 blah. Now, I'm not saying I'm some savant. All I'm saying is I looked at Meta and said, wait a second. Here's a company that's revenue is going up. It doesn't generate barely any money overseas on revenue compared to the US. There's a lot of upside. And 3.5 billion people per month use their products. What are the chances this company goes to zero? That was just my logic. And guess what? On this channel, people are like, you are wrong on this one. I was like, okay. And now I see people saying, oh, Meta's such a great company. Okay. So which one is it? Is it a great company at $650 a share, or is it a great company at $88 a share? It's a great company in both. It's a great investment at $88 a share, not as good at $650. That is the difference. Company, investment. A great company can be a bad investment and vice versa. You've got to remember that. Michael Burry made a crap load of money on GameStop, and GameStop is a crappy business. But he made a lot of money on it. Why? Because he saw value. So guys, every market crash has a story, and every story has the same line. This time is different. Just like every market bubble has a story, and every market bubble has the same line. This time it's different. Spoiler alert, it never is. In 2000, the dot-com bubble burst. Companies with no revenue, no earnings were being traded like they were the future of commerce. And guess what, guys? The future of the internet was insane. But guess what? When you pay too high a price for a good story, it becomes a bad investment. That is the fifth and most important tenet of our principle-driven investing. But what happened next with the internet was easy to overlook. While the media was obsessed over tech's implosion, value stocks quietly outperformed. Companies with real earnings, real margins, real cash flow, good balance sheets. They rebounded faster than anyone expected. Why? Because underneath the wreckage, principle still worked, and those value investments were underperforming in the tech bubble. Why? Because people wanted to follow the stories. Fast forward, great financial crisis. 2008, the story shifted again. This time it wasn't tech. It was the financial system. Too much leverage, too much speculation, mortgage-backed securities, derivatives that no one understood then, and they probably don't understand now. And once again, the phrase emerged. This is a once-in-a-century crisis. Banks collapsed, housing market imploded, S&P lost almost 60% from its peak in October of 2007 to the bottom in March of 2009. Panic dominated everything. But beneath the fear, there was structure. Cash-generating companies with low debt survived. Businesses with strong balance sheets kept operating and taking away business from their less quality competitors. And the patient investor, the one who stayed rational, was rewarded. Guys, in 2006, I sat down with two friends of mine. I tell this story a lot. They sat there and said, Paul, we want to invest for our future. Because at that point, they're only 3 years out of college. So they're young, 25, 24. I said, okay, let me ask you a question. If stocks fell in half tomorrow, what would you do? And remember, the wife looked at her husband, looked at me and said, we'd buy more, right? I said, perfect, you get it. Fast forward to the financial crisis. I get an email from the wife. What is going on here? What are you doing? I'm like, well, if you remember, we talked about this and I'm buying more. You're actually buying more? Well, yeah, we said this. Oh, no, but my money's going to go to zero. The U.S. financial system is going to zero. I was like, okay. Here's my response to that. And I did not say this to her back then. I wish I had. If the financial markets and the entire stock market is going to zero, all the more reason to buy more because your money will mean nothing. For the market to go to zero, there has to be absolute mayhem, chaos, Armageddon. Your money won't matter anyhow. So you might as well put the money to work, hoping for a rebound. Fast forward, by 2013, the S&P had fully recovered. I guarantee you my friends did not get back in until much, much later after recovery. And by 2018, many value stocks had doubled. Guys, remember I talked about the NASDAQ crash? In 2015 or 16, the NASDAQ finally hit the levels it hit in 2000. But guess what? If you started buying and dollar cost averaging in 2000 in the NASDAQ, you still made well into mid double-digit returns today by being disciplined. Then, fast forward, 2020, COVID came, the fastest bear market in history, almost a 40% drop in just 33 days. Panic wasn't just on Wall Street, it was everywhere. Boardrooms, households. Fear was rational, but so was preparation. Guys, we didn't know what was going to happen. But you know what's interesting? We were facing a shutdown in the US economy. But the low of the market was on March 23rd. I believe if you go back and look, we only had 5,000 cases of COVID at that point in the entire country, and we had not fully shut down yet. And that was the bottom of the market. What most people missed was that, once again, the pattern was playing out. Excess optimism, external shock, emotional selling, repricing, rebound. It happened very quickly. And I'm not saying that that's a normal thing. But those who stayed principle-driven, those who understood the companies they owned, would have realized that eventually we will come out of this. And when we do, those companies will do the best. This is the cycle. It has many faces, but the bones and the structure are always the same. A market overheats, expectations run too far ahead of reality, valuations disconnect from fundamentals, cheap debt fuels overexpansion, then something triggers the collapse. As Hussman always says, in a room filled with gasoline with a fire blazing in the corner, we don't know which spark will cause the explosion, but guess what? One of those sparks will cause the explosion. Whatever the trigger, the result is predictable. Prices fall. Fear spikes. Liquidity disappears. The narrative starts to fall apart. But what's the most important part? Principles reassert themselves because crashes are not just corrections. They're cleansing events. We need them. We need to get rid of all the easy money out there. Recessions force the market to ask better questions. Who is actually profitable? Who can manage their debt when it's no longer cheap? Who has a product that people will still buy in a downturn? Because in a downturn, people buy what they need. Weak business models get exposed. Zombie companies, firms that can only survive on low interest rates and easy capital, start to fail. They can't refinance. They can't grow into the insane valuations they had before, and they certainly can't bluff their way through a balance sheet. Even great companies with great balance sheets will take a hit if they're excessively overpriced. The story has to match the fundamentals. And when it doesn't, when there is a downturn, those companies get hit the hardest. The Magnificent Seven are riding on a euphoric wave, and they're all great companies, well, except for one, I think. And I won't tell you which one that is. But they're all great companies with great balance sheets. The question to ask yourself is, are they fairly priced? Because even great companies will fall in price. Microsoft hit $52 a share in 2000, got as low as $11 or $10 a share 12 years later. And this matters because recessions aren't just a punishment, it's a reset. It reprices risk. Economists have a term for this, the Minsky moment. Named after economist Hyman Minsky, it's the idea that prolonged periods of stability create an illusion of safety. That illusion leads to risk-taking. Risk-taking leads to fragility, and fragility eventually leads to cracks and a collapse. It doesn't happen all at once. It builds. It's like the pot filled with water and you have a lid on top of it, and it's boiling. And eventually it's going to explode. When? We don't know. But look what happens now. We have people believing that you buy in the market, it goes back up. The market goes down, it goes right back up. Is that healthy? I don't know. It doesn't feel healthy. But when this all does happen and happens quietly, eventually when it breaks or bursts, it's a tough one. The Minsky moment isn't about the trigger. It's about what's bubbling underneath long before the trigger is pulled, long before the explosion happens. And if you look around today, the bubbles are forming again. The US debt load is at record highs. Government spending continues to outpace revenue and GDP growth. Inflation, which is cooling, is still above the Fed's target. Global supply chains are more fragile than ever because of the geopolitical tension that is mounting. And while unemployment is strong on the surface, layoff trends are starting to tick a little bit upwards. White-collar sectors, tech, startups. There are early signals, not alarms, but friction. Now remember, we're not trying to be fudsters here. I'm not trying to put fear, uncertainty, and doubt in everybody's mind. But I want everybody to remember that there are a lot of things happening in the economy. And we tend to look at what's happened recently and not what could happen. But friction creates hesitation. Hesitation eventually leads to selling, and selling will snowball when liquidity dries up. What do I mean by liquidity dries up? In 06 and 07, I knew real estate people who said, I could just walk in a bank and get a credit line like that to buy real estate with my signature. When that goes away, there are less buyers out there. There's less easy money out there. What happens when there's less buyers out there? Prices start to come down. Same with funding of businesses, liquidity. If you can't get funding very easily, what's going to happen? It's going to make it harder to buy stuff. Now, it hasn't broken yet, but is there pressure building? I think so. But it doesn't mean you should be scared and run away. It brings us back to the principle. Cycles are inevitable. I always say there are 3 guarantees in life: death, taxes, cycles. How you respond is what you can control. That's the optional part. If you are chasing trends, every cycle feels like a betrayal. If you're grounded in fundamentals, every cycle turning feels like an opportunity. Because when markets fall, you're not looking for the bottom. You're just looking for disconnects between price and value, between panic and fundamentals. You're not trying to time the cycle. You're trying to think through it. So the next time you hear this time is different, remember it never is. And guess what? They'll rarely say this time is different because everybody knows what those words mean. They'll say it in a different way. Well, I understand how the internet was this way, but right now with AI, blah, 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 blah. That's just another way of saying this time is different. Well, I know real estate goes up 3 or 4% a year, but now with this, and this, I think it should be better. This time is different. What's different is whether you're ready or not, whether you've built your process, whether you're calm enough to act while others are scared. Crashes aren't invitations to panic. They're opportunities to apply everything you claim to believe. So guys, let's make this simple. We take a principle-driven approach to investing. Principle-driven investing isn't about timing the market. It isn't about predicting what's going to happen. It isn't about reacting to price charts. It's about ownership, logic, clarity. At its core, there are 5 tenets. These aren't quotes to memorize. They're filters to think through, especially when the world feels irrational. We're sitting here, and I created this as a way for myself to think. The first tenet: we are investors, not speculators. A stock is not a ticker. It's not a trend. It's not a gamble. A stock is ownership in a real business, real products, real employees, real customers, real cash flow. Speculators chase the moves in those prices. Investors study models. They study the leadership. They study the long-term viability. The difference: speculation can be a coin flip. Investing is a process. Both of them can get burned from short-term movements in the market. The difference is the speculator, when they see the price fall, doesn't know what to do. The investor knows exactly what to do when they see the price fall further. You are not here to predict. You will never buy the bottom. You're here to understand. Even my meta example, I bought the bottom after buying 5 times along the way down. And along the way down, people are like, see, you were wrong. You started buying at 200. I'm like, okay. But when I bought at 88 at the bottom, literally the day at the bottom, where were my accolades? And I'm not asking for accolades. That's the point of it. You hit the bottom when you're buying all the way along. You're not here to predict. You're here to understand. You're here to evaluate and to allocate capital with discipline. You work hard for your money. The way in which you disperse that money in investments should be done in a principle-driven way. Number 2, every investment is the present value of all future cash flows. This is the core of everything. You're trying to sit there and figure out what is the intrinsic value of a business. And that's determined by saying, okay, I take all the future cash flows, I bring it back to today's dollars by discounting it by a certain way. What's that worth to me? It's the math behind what a business is truly worth. If those cash flows are solid and predictable and you're buying below that number, that's a rational move. That's a value move. If you're buying hype without the numbers to back it up, that is speculation wrapped in emotion and wrapped in this idea that I'm investing because I'm putting money somewhere. That's not the case. If you determine you're right or wrong based on where a stock goes in the short run, you're probably not investing. You're probably speculating because anything can happen in the short run. But if you understand what a company can make in the future and you discount it to today, which we do in our software every single day, that will tell you what the right price to pay for you for this company. Tenet number 3, if you don't understand it, you don't invest in it. This is your filter. This is your guardrail. Warren Buffett in the 2000s said, I don't get how these .com and tech companies, I don't understand how they're going to make money in the future. He didn't say they wouldn't. He just said, I cannot guess reasonably what they're going to make in the future. I don't understand it, so I don't invest in it. If the business model is vague, if it's too early, if you can't explain how they make money, you're probably going to have a hard time explaining how they will lose money. And if you're relying on someone else's conviction, you're outsourcing your risk, but you're the one that's going to pay for that risk. That's the problem. Guys, we have a great tool in our software called Stock Analyzer. It's used over 1 million times every year by our users because it allows people very quickly to look at a company and say, should I spend more time on it? You put in your assumptions and you do that. It's not about guessing fully. It has a low, middle, and high range. You can give a low range, a middle range, and a high range on the growth levels, on the profit levels. And it'll tell you very quickly where the price that you've determined you want to pay is relative to the market. It's just a shortcut. That's what we're all looking for here. We don't want to spend hours and hours trying to build models in Excel, and that's not worth it. It's about putting the narrative, the story together with the math. That's the key thing there. That's why it's used so much. Clarity breeds conviction. The clearer you are in what you're seeing, the more convicted you will be about it. Conviction allows action, especially when others freeze. It's very difficult to do. That's the stomach part. That's what we're here for. Like I said earlier, 86% of the people who watch our channels watch them to get ahead. Well, getting ahead, I love it because the future is probably not going to be as great as the last 5 or 10 years. The next 5 or 10 are probably going to be harder. Tenet number 4, In the short run, stocks are a voting machine. In the long run, they're a weighing machine. What that means is what's popular in the short run is going to go up in price. What's not popular will go down. But in the long run, what will drive the value? The fundamentals of the business, the weight of the business. This is your emotional anchor. Markets move on opinions in the short run, on fear, on euphoria, both in the up and the down. But in the long run, they reward the fundamentals, discipline, cash flow, and give it time. So when prices plunge, principle-driven investors do not panic. They assess, is the business broken? Or is the market being emotional? If it's emotion and the fundamentals are still intact, you should probably look at buying more. Not because you want to time the bottom, but because you know the weight is still there and will drive the value in the future. You understand the business, you understand the numbers, you've built in margin of safety, and that's why emotional detachment is your edge. Let the market vote. Let others react. You will weigh everything. This isn't about brilliance, it's about behavior. It's about emotion. It's about keeping your emotion in check. Now, the fifth tenet, and probably the most important one, a great story can become a bad investment if you pay the wrong price. This one is brutal because it means you can be right about the company and be wrong about the investment. Because we all fall in love with stories. I have, we all have. Tesla, Nvidia, Apple, incredible businesses, Microsoft. But at the wrong price, they become bad investments. Price always matters. The true investor knows that the right business at the wrong price is a bad idea. Now, we've all heard Munger say, well, if you have a high, top quality business, paying what appears to be an expensive looking price is still good. And he's absolutely right. But people use that to justify paying enormous prices for companies. And the reason why this sucks is the true value investor will oftentimes, if not always, look wrong. Because when stocks are flying high and they're not buying, the stock keeps going up, you look wrong. When the stock is falling and you are buying, like my examples in the past, you will look wrong. I guarantee if I ask that tech CEO today, what he thinks of Microsoft, I guarantee his statement will be incredible business. And he'll probably deny ever saying it was a dead company or a dying company. We wait when everyone else is sprinting and we go in when everyone else is getting out. The short-term stock market is a popularity contest. The long-term is a weigh-in. So while others chase momentum, we have to ask, does the business justify the price I'm paying? If the answer is no, we just wait. If the answer is yes, even during panic, we act. But we got to remember that when it falls, we likely did not buy the bottom. We have to be okay seeing it fall further. In fact, Warren Buffett says, if you can't stomach a stock falling 50% when you buy it, you should not own stocks. 3 times in Berkshire's history, they said Berkshire Hathaway lost 50% or more of its money. And Munger and Buffett both said we did not feel any poorer because they understood the value of the business. They're programmed very differently. Principle-driven investing is simple, but it isn't easy because it demands that you stay rational when others around you, your friends, your family, the media, are all irrational. That you trust process over noise. That you measure value, not hype. It isn't surprising to me that I get the most requests for advice when things are bad, and I get told the most that I'm wrong when things are good. This is not a coincidence. Now, I have a free gift for you. You've made it this far, which means you are one of those people who wants to get ahead. You want to be smarter. And it's a little bit of a process, but we make it a lot easier for you. So I want you to download our free PDF on principle-driven investing by clicking the link in the description. We're going to email you to you right away. It's absolutely free. It's a simple, clear guide that will help you build the mindset and thought process you need to take action the next time a market downturn brings opportunity to you. Guys, I read these things daily. The next time you feel fear pressing at the edge of your decisions, come back to the 5 tenets. They won't change, even if the market does. And you can apply this to any investment you're making. Real estate, bonds, stocks, personal, doesn't matter. But that's what the principles are for. So, the market falls. Now what? Don't panic. Don't try to time the bottom. That's a game nobody's ever going to win. Here's a smarter way. It's called dollar cost averaging. That means you invest a little bit of money regularly, week, month, year, whatever, doesn't matter. So when prices fall more, you can choose to add more, but only if it's a business you understand and believe in. Guys, we always say, the market is going to go up like this over time, but the price is going to change like this. Dollar cost averaging takes away all this worrying about when you're buying, and you're going to average buying this. Sometimes you're overpaying, sometimes you're underpaying. Overall, you're buying the market. And for those of you who have a little bit more gusto, increase how much you invest when it's below the market line. And I talk about valuations every week on our channels. Now, that's dollar cost averaging. But you might sit to me and say, hey, Paul, I want to buy individual stocks. Great. We love doing that. A great place to start is look for stocks that are at the 52-week low. That means it's the lowest price they've been in the last year. It doesn't mean the stock is cheap. It just means that it's a great company that's dropped because of news, like a virus, a war, or something else, or there's a million reasons it could drop. But that could be your moment. It's a great place to start. Don't cheer for crashes like I do, but be ready. Have a plan. Know what companies you want to buy and when they go on sale. That's why we have our watch list on our software. We put the companies we want, we notify the price we want after doing our stock analyzer, and then we get an email or an update when it hits that price. Guys, spoiler alert, I haven't gotten many emails lately on my stocks because the market has been up a ton. Finally, investing isn't about being the loudest, smartest, or fastest. It's about being calm. When the market crashes, a lot of people will panic. And guys, it doesn't even take a crash. If the market's in a longer-term bear market, people will panic. They will give up on stocks. Some will sell everything. Some will say stocks are toxic, but not you. You'll remember the lessons. You're going to stay patient. You've made it this far in this video because you're a patient person, and the stock market rewards patience. Look for value. That's how real investors grow their wealth over time. Thank you for your time.